Imagine waking up one morning and discovering that the global financial system, every major bank, every pension fund, every corporation, was sitting on a hidden explosive bet worth more than the combined GDP of the entire planet. A bet so large that if even a tiny part of it failed, it wouldn't just trigger a recession, it would vaporize entire countries' financial systems in minutes. Most people don't know this. Most investors don't want to believe it. But right now, in 2025, the world is staring directly at a $600 trillion time bomb. And history has shown us every single time governments and banks try to hide risks of this scale, the crash that follows is brutal, fast, and far worse than anyone predicts. This is the story of the crisis that's already baked into the system. The story no politician wants to talk about, no banker wants to admit, and no investor wants to face. A story that traces back to the silent machinery underneath the financial world, the derivatives market. If 2008 was an earthquake, what's coming next is a financial tsunami. And the terrifying truth? The numbers today make 2008 look small. Before we go deeper, ask yourself one question. What happens when a bet larger than all the money on earth goes wrong? Stay with me. Because once you understand this pattern, you'll start seeing warning signs everywhere. Signs the elites already know and quietly prepare for. And if you're new here, subscribe so you don't miss the moment this shock finally hits. Let's travel for a moment back to September 2008. A man named Kevin Wang, a mid-level analyst at Lehman Brothers, walked into the office holding a cup of coffee. He didn't know it yet, but within 4 hours, the company he had given 15 years of his life to would collapse. His retirement, his stocks, his entire future vaporized. He watched employees leaving with cardboard boxes, some crying, some silent, some in disbelief. People think the 2008 crash was about mortgages. It wasn't. Mortgages were only the spark. The real explosion came from the derivatives built on top of those mortgages. It wasn't a $600 billion problem. It was a $600 trillion one, because derivatives magnify everything. They turn small risks into giant ones. They turn tiny cracks into catastrophic failures. Fast forward to today, and that same hidden machinery is now bigger, more complex, and more fragile than ever. According to BIS data, the notional value of global derivatives now exceeds $600 trillion. That's not a typo. That's not fiction. That's not alarmism. That's math. $600 trillion. An amount so large that if you stacked it in $100 bills, you could reach the moon and back more than 30 times. And yet, 98% of people have no idea they even exist. You might think, but surely governments have this under control. Let me make this painfully clear, they don't. Because you cannot control something you don't fully understand. And right now, we're living in an era where interest rates, inflation, wars, supply chain breakdowns, political tensions, and AI volatility are all colliding. The entire system is shaking, and the derivatives market is the massive, invisible weight sitting on top of it. To understand why this crash will be worse than 2008, you have to understand what derivatives actually are. Think of them as bets. Not buying stock, not buying a house, not buying gold, no. Derivatives are bets on how those things will move. They're like insuring a house you don't even own, then selling that insurance to 10 other people, and then betting again on whether the house will burn down. When everything stays calm, the system looks stable, profitable, efficient. But when things start to move, when interest rates spike or inflation surges or currencies wobble, those bets can go bad fast, extremely fast. In 2008, the world nearly collapsed because bankers made bets on U.S. housing prices. Today, they're making bets on everything: interest rates, oil, wheat, credit, foreign currencies, government bonds, corporate defaults, even volatility itself. Now imagine a Jenga tower. Each derivative is a wooden block stacked higher and higher. In 2008, a few blocks fell. Today, half the tower is leaning and the remaining blocks are cracked. All it takes is one wrong move, one unexpected event, and the whole tower collapses. And here's the part nobody wants to admit. We already know which block is loosening. It's called the interest rate derivatives market. In the last 2 years, global interest rates have gone through the fastest increase in 40 years. Trillions of dollars in bets were made assuming rates would stay low. They didn't. And now major institutions, banks you recognize, pension funds you trust, governments you rely on, are holding losing bets worth billions. They're underwater, they're silent, and they're hoping no one notices. In 2022, the UK nearly collapsed when pension funds blew up because of derivatives tied to long-term bond yields. The government had to intervene within 48 hours to stop a full meltdown. That was one country, one corner of the world, one tiny pocket of the $600 trillion system, and it almost took down the fifth largest economy on Earth. What happens when the next shock isn't small? What happens when it's global? Let's zoom out and see the pattern. In 1998, a hedge fund called Long-Term Capital Management collapsed under the weight of its derivatives exposure. The Federal Reserve had to orchestrate a rescue. In 2008, AIG collapsed because it sold too many derivative insurance contracts. The U.S. government had to bail it out. In 2023, we saw banks like SVB fail because they made wrong bets on interest rates, and the contagion almost spread instantly. Notice anything? Every major financial collapse in the last 30 years has derivatives lurking at the core. Now let's fast forward to the present day. A young couple in New Jersey sits at their kitchen table. Their mortgage payments just increased again. Groceries are more expensive. Gas is more expensive. Everything is more expensive. They don't realize it, but thousands of miles away, a bank in Europe has made a massive bet on the direction of U.S. interest rates. If that bank loses, and it's already losing, the ripple effect will reach them. It will reach you, because that bank might freeze lending, or be forced into panic selling, or cause credit markets to seize up. You won't read this in headlines, you'll just hear phrases like liquidity problems or market instability. But behind those phrases is the same monster, derivatives. Why will this crash be worse than 2008? Because in 2008, the system had room to absorb the shock. Rates were low, governments had money, central banks could cut interest rates. Today, interest rates are already high, inflation is still a threat, government debt is at all-time highs, and central banks do not have the tools they once did. There's no easy solution left. The safety nets are already stretched thin. Let me give you an example that almost no one talks about. In Japan, interest rate derivatives have created a financial black hole. Japanese banks made massive bets assuming rates would stay negative forever. But now inflation is rising, and Japan is being forced to raise rates. If those bets go wrong, and they are starting to, the consequences won't stay in Japan. They'll spill across Asia, into Europe, into the United States. That's the danger with derivatives. Risk doesn't stay local. It travels, multiplies, and explodes outward. So here's the million-dollar question. What triggers the next big collapse? It could be anything. A war that disrupts energy markets, a sudden drop in real estate prices, a currency crisis, a surprise interest rate hike, a failed treasury auction, even a cyber attack on a major exchange. In a $600 trillion system, you don't need a giant event. You just need a spark. Let's consider a scenario. Imagine a major European bank suddenly reveals it has a $50 billion loss on interest rate. Derivatives. Investors panic. The stock drops 30% in a day. Depositors start pulling money. Other banks stop lending to it. Credit markets freeze. Hedge funds with exposure start dumping assets to cover their losses. U.S. Treasury yields spike. The stock market plunges. Pension funds take heavy hits. Within 72 hours, the fear spreads worldwide. Countries blame each other, markets halt, governments scramble, the shock becomes unstoppable, all because of hidden bets no one saw coming. Sounds dramatic, right? Except it already happened before. Lehman Brothers, Bear Stearns, AIG. And every time the government stepped in. But the next time, when the system is larger, faster, more complex, stepping in won't be so easy. In the middle of this chaos, people will ask the same questions. Why didn't anyone warn us? How did nobody see this coming? But the truth is, the signs were there all along. The debt, the leverage, the reckless bets, the fragile confidence holding everything together. We're living in a financial world built on sand, and the tide is coming in. If you're still watching, this is the moment to subscribe, not for entertainment, but because understanding these patterns before they unfold can protect you, your family, and your future. History rewards those who prepare early and punishes those who ignore the warnings. Let's go even deeper. In the United States, total government debt now exceeds $34 trillion. Corporate debt is near $10 trillion. Consumer debt is over $17 trillion. And all of it, every bond, every loan, every interest payment, is tied into derivatives. If interest rates move unexpectedly, the shock will ricochet through every layer of the system. Pension funds, insurance companies, banks, hedge funds, even everyday people with mortgages and car loans. A retired school teacher in Ohio might have no idea that her retirement fund uses derivatives to hedge its bond portfolio. If those derivatives fail, her pension check may shrink. A truck driver in Texas might not realize his company's fuel costs are hedged with commodity derivatives. If those bets blow up, his company might lay off workers. A homeowner in Florida might not know their mortgage lender relies on derivatives to manage interest rate risk, but if those bets turn toxic, that lender could go bankrupt. Derivatives are the invisible strings connecting every financial decision we make, and when those strings snap at once, the entire system unravels. So what do the elites know that most people don't? They know that derivatives are both the engine and the Achilles heel of the global economy. They know that liquidity can disappear in hours. They know that a single failure can cascade through thousands of contracts. They know that once panic starts, it accelerates on its own. And here's the darkest truth. Many insiders are already preparing. They're reducing leverage, moving assets into safer instruments, buying hard assets like land and metals, quietly shifting into defensive positions. But ordinary people? Most are still living paycheck to paycheck, unaware of the $600 trillion storm forming above them. There's still time to prepare, but not much, because every day the system gets more stretched, more fragile, more unstable. Every month brings new data showing rising defaults, declining savings, and higher borrowing costs. Every year, the cracks get deeper. If you found this eye-opening, share it to warn others about these hidden economic patterns. And if you want to stay ahead of the next financial shock, before headlines break, before politicians react, before markets panic, subscribe now. This channel is your early warning system in a world full of financial illusions. The $600 trillion time bomb is real. The question is not if it explodes, but when. And when it does, the world will look back at 2008 and call it the warm-up.